just to make sure it's over there. Okay, it's on. Hey, let's start the webinar. Okay, hello. Good morning, everybody. Thanks for tuning in. So this week we have more webinars than usual. Actually, we're like doing 3 webinars in this week because both of us will be traveling and we are traveling at a different time. So tonight I'll be flying to US to meet my son there. So to visit his school. Actually, they have like family parents day or something. So and I got to know that his college got a nuclear reactor that we can actually go in and have a look. So it's a
Oh,
tour lah for the nuclear reactor. I was thinking, okay, nuclear reactor, okay. And then after I come back, and then Ian is going to travel again. Ian is going to his honeymoon for the third time, is it? No,
it's
second time. New Zealand.
New
So
Zealand.
like, so it's like we revise the honeymoon. Okay, so glad for Ian as well as having a great vacation ahead. So that's why we cram a lot of stuff during this week. So thank you very much for everybody for being here. And whether you are a Growth Walk member or Dividend Walk member, or you are not yet any of our membership members, today we have no hold back. We will share with you a lot of the I think the most essential thing that we actually learn about stock investing.
Mm,
And today, Ian is going to help you understand that. So that when you do start investing on your own, or whether you are learning more with us, or you go with other people, or you just do your own readings, I think these are the area that you want to read more about. So without further ado,
mm.
let's welcome Ian.
Yes. Good morning to all of you. Good morning to Casey. And yeah, thanks for the introduction. Always a privilege, a nice feeling to be here to present to you guys a little bit of learnings, experiences when it comes to stock investing. So today's syllabus is going to be a little bit heavy, but it's actually very essential. Because what I'm going to do here is that we're going to talk about something which is really, really exciting. So let's get into the slides. So today we are talking about 10 baggers. And here I'm going to distill to you the 5 equations that drive it and how can investors like you and me attain it. And before I begin, there are always the usual disclaimers. So let me just read it out to you guys very quickly, and then we can get the syllabus right away. The stock strategies and all information presented in this case study webinar is for educational purposes. They are strictly not intended to be an investment, trading, or financial advice. No warranty is made with respect to the accuracy and reliability of the information presented. The co-founders of Growth Walk wish to disclaim all rewards and risks arising from any direct and indirect use of the information presented. Last but not least, if you require professional and specific advice, please consult a relevant professional. Okay, so guys, what exactly is a 10 bagger? So a 10 bagger is essentially a stock whereby the investor invested, let's say, $1,000 into the stock, and over time it has compounded itself from $1,000 to $10,000. So if you invested 1,000, it becomes 10,000. If you invested 10,000, it becomes 100,000. If you invested 100,000, then it become 1 million. So that is actually a 10 bagger. Now, guys, type in the chat box. Let me know if, let's say, there is a stock that is a 10 bagger or that has 10x um, the capital invested by investors. What is the first stock that you have come across? And you may actually type in the chat box. Let us know. Be interactive with us. It's going to be a very interactive, very lively discussion today. What is the first stock that comes to mind? And put it in the chat box. The first stock that you think it's a 10 bagger, put in the chat box. Let me know. Put down in the put down in the chat box. And of course, along the way, if you have any questions, please, how I say, please put your questions in the Q&A box. Oh, looks like there are many stocks that are being placed inside the chat box. So we have Connie Chan. She's typing it in Chinese, 可口可乐, which means Coca-Cola. All right. We have Shatiswara, Tesla. Okay. We have
Mm.
Vincent, Palantir, Nvidia, Choi Chi Kong or Uncle Choi, or Uncle Chi Kyung, KGB. And then we have Clement Bui, Meta. All right. Thank you so much for your responses. And let's see. All right. So this is essentially a 10 bagger. All right. So we have the capital 10,000. Eventually it grows to 100,000. So a 10 bagger is a stock that 10x its shareholders' capital. Fantastic. Now, these are some of the examples of a 10 bagger. Actually, they're not too hard to find. We can find plenty of them. A lot of them are actually in the US stock market. So these are just a few examples. So we have Alphabet. All right, we have Alphabet. So there is a time where investors can invest in it at a price of $28.15, and eventually it has grown to 281.48. So this is the price at the time that I prepared the slide. So from 28, it goes up to 281. For Apple, 27 to 271. So this is also, so these are actually historical price. So it's actually doable. It has already been done. All right, it has already been done, proven that these stocks actually exist. All right. We have Berkshire Hathaway, 47 to 478. Costco from 92 to 920. Microsoft from 52 to 525, and Visa from 34 to 345. So these are 10 baggers. All right. And if you take a look at the brands, the company names, these are also well-known brands. So they are actually really, really not hard to find. But the question is that although they are present, but it's not that everyone who invested in this company, they actually achieve 10 baggers. Okay. Simply because all these 10 baggers, right? If you're aiming for 10 baggers, the one thing that we need is that we have to allow our investment to compound over time so that we can attain the 10 baggers. So it takes time to actually produce this kind of a compounding effect. So let's see how long does it take for these 10 baggers to actually hit their baggerdom status. So if you take a look at Alphabet, how long does it take from it to go from $28.15 to 281? So the answer is 10 years. So Alphabet took 10 years to 10x its capital. Apple took 9 years. Berkshire Hathaway, 22 years. Costco, 13 years. Microsoft, 9 years. Visa, 13 years. Okay. So if this is 2025, that means to say, if you want to hit baggerdom status, so for those investors who hit the 10 bagger status, what they have done is that they need to have realized that Alphabet is a pretty good an investment in 2015. So in 2015, they must actually, okay, they allocated some money into Alphabet and they don't touch it. No touching it ever since. Just sit still, hold on to your Alphabet, and then you can see that his capital goes from 28 to 281. So it's a period of 10 years. Okay. So now next, let's move on. Now the question is, how can a stock actually 10x in share price? So how does it work? Now type in the chat box, let me know that, Ian, 10x in stock price. Really? Can it be done? Is it something that we should be aiming for? If at this point in time you have any doubts saying that this is something that is not quite workable, then type one. Type in the chat box, say one. It's not quite workable. I don't have this kind of vision. Type two, if you say, actually, I've seen this before. I think it's actually workable. I think it's actually within reach. It's something that you can actually do. All right. So if you have the mindset and belief system that at this point in time, believing that an investment into a stock uh can actually return 10 times the investment amount, type in two. Let's see in the chat box what exactly is your system, what exactly is your belief system at this point in time. One for cannot be done, two for can be done. Put it in the chat box. Let me know. Uh, so Vincent Tan says two, 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 two. Okay, so everyone seems to say that this thing can be done. All right, fantastic. So great. I guess Casey, webinar's over. Everyone believes that it can be
Everyone believe, right?
done. Nobody believes that it cannot be done. Uh, okay lah. So since everyone believes that it can be done, so the question is that what exactly are the factors that allow it to make it happen? Type in the chat box. What exactly is the factor that enables a stock to go from 1 to 10? What exactly is the key factor to focus on in order to achieve that? So Oiming says can if business is scalable. Anyone else? Put it in the chat box. Let me know. This will be a very important session because if you want to actually achieve, if you're aiming for 10x, then you need to know the factors that actually determine how does it happen. What are the rationale behind it? When you know the rationale behind it, then you can actually focus on the needful stuff in your stock investing, in your journey as a stock investor in building your portfolio. And you will actually weed out all those other stuff that is not necessary, that is not really helpful towards helping you achieving the 10x factor. Okay, so with that, let's continue. Now, in order to explain or the rationale, the logic behind that 10 bagger, right? So over here, I'm going to just do a simple case study and so that I can distill all the factors that are necessary for all of us to actually aim for a 10 bagger. So the case study for today would be AutoZone. So AutoZone is a company, for those of you who are not familiar with AutoZone, so AutoZone is a company that retails and distributes automotive replacement parts and accessories in the United States, Mexico, and Brazil. So it says the Americas. So North America will be US and Mexico. South America will be Brazil. So this is actually the nature of the business. All right. They sell automotive replacement parts. So this is another example of a 10 bagger. So what happened is that if you happen to invest in AutoZone in 2013 at the price of 420 US dollars per share, so capital in 2013, just sit still, relax, don't do nothing, don't do anything for the next 12 years, you will see its stock price growing from 420 a share to 4,200 a share. So if this is $10,000 that you invested in, your investment value will now have grown to $100,000. But it takes a period of 12 years. Okay, so there's a caveat. So it's not to say that, 10,000, it becomes 100,000 in 1 year. Have you seen any stock, Casey?
In 1 year.
10,000 becomes 100,000 in one
There,
year.
there are instances lah. but usually these things short-lived. So for
Mm,
example, I think Tesla happened also. I think there's a during 1 year period it actually shoot up like 10 times.
mm,
I think Top Glove also during COVID time, I think.
mm.
Mm,
Yeah. So there are examples like that.
mm,
Okay, they can actually double, triple, or even five times their stock prices in 1 year. But like what Casey said, these are not very sustainable.
mm,
So if you're coming into this webinar thinking of trying to shoot up like this, shoot to the moon, and it's actually very fast, it's not very sustainable. So that's actually not exactly what we do here in this webinar. Here you can see that the multitudes of examples whereby 10 baggers are achieved. And these 10 baggers, the key word here is sustainability. So it's not just, it has actually gone up by 10 times, but is it sustainable or not? And why is it sustainable? So this is actually the persoalan. This is the questions that we are going to answer for this webinar session. So AutoZone has achieved 10x in 12 years, but what are the factors? Now let's take a look. So if you are, in order to actually go from 1 to 10, all right, 10 baggers in 12 years. So how fast does the capital, so what is the compound rate of your capital? Okay. So to go from uh $10,000 to $100,000 in 12 years. So if you use a compound annual growth rate calculator or a CAGR calculator, you will have calculated that, hey, the money, the capital, has compounded at a rate of 21.15% per annum. All right. So to go from here to here, the stock price, the share price must compound at a rate of 21.15%. All right. So now I'm going to give you the first equation. All right. So here what we are going to do is that we are going to look at 5 equations to figuring out how does a 10 bagger work. So this is equation number 1, which is basically the 2 main reasons of why people invest in the stock market. So this is how returns are usually calculated. So here we have total returns, and total returns is actually a combination of 2 things. Number 1, capital growth, which is the first reason why people invest in the stock, is for capital growth. The second reason why people invest in the stock is for its dividend yields. So for AutoZone, over the 12 years period, capital growth, so capital has compounded at the rate of 21.15%. Okay, so this is capital growth. In this 12 years period, AutoZone pays no dividends. So in terms of dividend yields, it's zero. So this plus this will give you your total returns of 21.15%. So essentially for AutoZone, 100% of your total returns come from capital growth, which is a compound annual growth rate of 21.15%. So that's equation number 1. Now, from here, we are going to invert. Invert simply means we want to understand, okay, so now I know that I have established the fact that in this 12 years period, AutoZone has compounded the capital by 21.15%. So what exactly are the factors that contribute to capital growth? This kind of rate of capital growth. With that, let's move on. Let's take a look. So how did it compound at 21.15% per annum? Well, we are going to invert this formula, which is PE ratio. So this is PE ratio. On the left-hand side, this is the formula for PE ratio. So we have PE equals to stock price divided by earnings per share. Okay, now type in the chat box. How many of you are new to this formula? All right. If you are new to this formula, type in 1. If you know this formula for ages, type in 2. All right. Means if you're already, yeah, Ian, I know about PE ratio. I've been using PE ratio for years, for decades. Type in 2. Okay, so we have Shatiswara, we have 1. All right, we have Lokeswaran, 1. Clement Bui, 2. Okay, so some of you guys type in 1 because you are new to PE ratio. Some of you guys like KK Chong, uh, KK Chong, Clement Bui, you guys have been well versed with PE ratio. Fantastic. Okay, so this is the formula. PE ratio equals to stock price divided by earnings per share. So just to give you one brief example before we move on. So this is actually a measure of valuation. This is a valuation metrics. This is what investors use to value a stock. So let's say, for example, a stock is able to earn $1 per share. And if the stock price is 10, so which means to say 10 divided by 1, and this will give you a PE ratio of 10. And this will be compared with another stock. So let's say another stock, it is actually also earning $1, but this time the stock price is 20. So it's 20 divided by 1. So the PE ratio is 20. So once we got side by side, the same company, which is earning earnings per share $1, but one is having a PE ratio of 10, the other one having a PE ratio of 20. So we will simply assume, or we can have a view saying that 20 is a little bit higher than 20 is higher than 10. So therefore 20 is actually more expensive as compared to 10. That is the simplest way of putting it. But the art of using it is a different thing. All right. So the art of using it is actually more complex. But this is just to give a very basic, how would I say, PE ratio 101 kind of a knowledge, just to actually get you started lah. All right. Now we are going to invert this PE ratio in order to find out how are stock prices calculated. So to understand how stock prices are calculated, what we are going to do is that we're going to take this formula. You see this EPS? We're going to just bring it over up. We're just going to bring this up here. So it will come to the right-hand side of the screen, whereby this is actually the formula to calculating stock prices. So we have earnings per share, and we have PE ratio, and this times this equals to stock price. Now with this formula, it will gives us, or it will leads us to the next two factors that contribute to capital growth. So in order for stock prices to grow, what you need is this. You need the stock's earnings per share to go up, and you also need the stock prices, you need the stock's PE ratio to also go up. So if earnings per share go up, PE ratio also go up. Therefore, this will contribute to capital growth of your stock price. Okay, so now we are going to measure how is it like for AutoZone. So this is actually the case for AutoZone. At the top half of the screen, it is actually related to AutoZone's earnings per share. At the bottom half of the screen, it is about AutoZone's PE ratio. So if you take a look at AutoZone's earnings per share, which is represented in red color, what we can see is that in the 12 years period, AutoZone's earnings per share has increased at a rate of 14.84%, up from $28.28. So this is the earnings per share. And it increases all the way up to $148.80 in earnings per share. So this to this is a compound annual growth rate of 14.84%. Now let's take a look at the bottom half of the screen. So this is PE ratio. So last time in 2013, if the person invests in AutoZone, he is buying the stock at a PE ratio of 14.85. At this stage, in 2025, the PE ratio of AutoZone has increased to 28.22. So which means the stock has become a little bit more expensive lah. All right. As you can see, its PE ratio almost doubled. From here to here, the PE ratio growth, the compound annual growth rate here is 5.5%. So this plus this will contribute to your capital growth of 21.15%. So now the question is, which of the two is actually the major contributor to the to AutoZone's capital growth? Is it earnings per share growth or is it PE ratio growth? So this is actually where we see which is the major contributor, and from there, as investors, we will put our attention, put more of our focus on that factor. So between the two, earnings per share growth and PE ratio growth, it is earnings per share growth that is more major as a factor as compared to PE ratio growth. So in this case, what we will do is that for stock investors, this earnings per share growth will be the more essential factor that we are going to focus on in order to achieve a 10-bagger result. As for PE ratio growth, this is actually related to whether investor like to buy more of the stock or doesn't like to buy the stock. All right. So if the investor like to buy the stock, then the PE ratio of the stock will go up. If the investor don't like the stock, then of course the PE ratio of the stock will come down lah. So this one is actually it's less controllable for most stock investor. So therefore, we will actually not put a lot of emphasis on this lah. So Casey, do you put emphasis on PE ratio growth? How do you view this?
You, it's more like you cannot bet on the PE growth to give you a long-term return. So it's like, okay, now when you get to buy AutoZone at PE 15 and now it is 28, so it's good news for everyone, right? But you can see that if the market crash and then the PE drop back to 15 level, so the average level, then this stock still give you very good return because we still get the earning per share, which is like 15%, 14.84. But in the short term, PE is the one that actually give you the most return in the short term. Uh,
True. So this is actually the short term factor lah.
yes.
You can say that as well lah. This is like the short term factor. This is
Mm.
actually more like the long term factor lah, the
Yes.
EPS growth. So now the question is, what contributed to AutoZone's EPS growth? With that, let's move on to the next part of
Because it's also quite logic, ma. If you want to get the 10 baggers, if you're buying a stock at PE of 10, you cannot expect the PE to become 100 to give you that 10 baggers, ma, right? So
true also.
it might happen lah. Like sometimes it happened to stock like Nvidia, you know. So in the short term you get that result. Of course, that is to us is lottery ticket lah. So sometimes you hit it lah.
Mm.
Mm.
But of course, with this study of 10 baggers,
Mm.
obviously, both Casey and myself, we have actually studied countless of stocks. All right. And usually, after you work out the mathematics, right, usually it is the EPS growth that is the major one for most stocks. It's not the PE ratio growth that counts lah. All right. Sometimes you may even find the PE ratio growth, there's no growth. It's like
Mm.
small negative. But because the earnings per share growth is too, how I say, it's such a big factor, right? It still
Mm.
give you the 10 bagger results.
Yep.
Yeah. So now we are going to move on to the next part, whereby we're going to invert further. It's like, okay, I get it. Earnings per share growth is like the major factor that contributes to capital growth. And for AutoZone, it has compounded its earnings per share at a rate of 14.84% per annum. So now the question is, how did AutoZone's earnings per share go up from $28.28 in 2013 all the way up to 148.80 in 2025? What exactly is the factor? So with that, we are going to invert further by understanding first the formula to calculate earnings per share. So this is the formula to calculate earnings per share. So this is EPS, and it is calculated like this. EPS equals to, first, you must have the company's earnings, and then you divide it with the company's number of shares. Okay, so if the company earns $1 million and it has 1 million shares, so therefore 1 million divided by 1 million shares, you get an earnings per share of $1. So in order for earnings per share to go up, your earnings must increase and the number of shares must reduce. All right. So that is the case in order to get the earnings per share to grow. So what is it like for AutoZone? Well, this is the case for AutoZone. So on top, at the top half, we have AutoZone's earnings. At the bottom half, we have the company's weighted average number of shares, which is its share count for AutoZone. So let's take a look at AutoZone's earnings. Over here, based on its annual report, we can find that AutoZone's earnings have increased from $1 billion US to 2.5 billion US dollars. So it has gone from 1 billion to 2.5 billion in 12 years. Okay. So this is actually a compound annual growth rate of 7.78%. Now take a look at the number of shares at the bottom half of the screen. So over here, we have 2013, when it made 1 billion share, when it made 1 billion US dollars, the company has around 35.9 million shares. So this divided by this, you will get your earnings per share of $28.28. 12 years later, its earnings have increased to 2.5 billion US dollars. So earnings have gone up. Its number of shares have come down from 35.9 million shares to 16.8 million shares. So if you take this, divide by this, you will have an earnings per share of $148.80 in 2025. So earnings gone up, number of shares come down. Earnings have compounded at the rate of 7.78%. Number of shares have reduced at the rate of 6.15%. So this plus this, they will contribute to earnings per share growth of 14.84%. Now, over here, since both factors seems to be contributors to earnings per share growth, so we are going to look at two factors, how they actually work to get this EPS growth rate of 14.84%. Now, I'm going to first start off with the number of shares. Then subsequently, we are going to continue to invert the earnings growth here, which is 7.78%. Now, let's take a look at this share reduction, where the reduction rate is 6.15% per annum. Okay, So this 6.15% per annum in share reduction. So how do you actually reduce the number of shares? Well, the answer is the company, once it's profitable, if it's generating cash flow, the company can use the cash flow to buy back its shares from the open market and therefore reducing the number of shares in the stock market. Uh, so that is the case. So in order to do this, the first main criteria the stock must achieve is this. The stock must generate consistent growth in operating cash flow. It has to be positive, it has to be growing. So take a look at AutoZone. So can you see that in this period of time, AutoZone's operating cash flow is positive. It's generating billions in operating cash flow, and it is growing over time. So with this operating cash flow, then the company can take this money to do many things. And one of the things that they can do is share buyback. So take a look at this. AutoZone from 2013 to 2025, they have generated 30.2 billion US dollars in operating cash flow. Okay, from which AutoZone has I won't say generated, but I would say they have utilized 25.4 billion dollars in net share buybacks. So which means a lot of this cash flow will go into share buybacks. So this is the amount they have. They have spent, or should I say net spending, on share buybacks. And because they spend 25.4 billion US dollars in share buybacks, this is how you get your share reduction of 6.15%. So this is actually how it happened.
Mm.
Okay. So now we are coming back to the third equation, whereby how do you get earnings per share growth of 14.84%? You need two factors to work hand in hand. Earnings growth, 7.78%. This is the case for AutoZone. And we have a share reduction, which is at the rate of 6.15%. So this only can happen if the company is cash flow positive, generating billions, growing amount of cash flow from its operations, and they are willing to use that cash flow to buy back its own shares. That's how you get share reduction over time. Now, we are going to invert further because we know that AutoZone has increased its earnings from 1.02 billion US dollars in 2013, and it has increased it all the way up to 2.5 billion US dollars in 2025. So this is a compound annual growth rate of 7.78%. So the question is, what exactly contributed to AutoZone's compound in earnings for the 12 years period? So with that, we are going to look at how earnings are calculated. Okay? So earnings are calculated like this. So we have revenue. This is also known as sales. So let's say revenue of a company, $100. The cost, all right, the cost to deliver your products and services, labor costs, interest costs, rental costs, tax payments, etc., etc. Let's say the cost of it is $80. So this will give you a profit of $20, right? Because revenue minus cost equals to profits. So if revenue is $100, cost is $80, so your profit is $20. So what exactly is your profit margin? So your profit margin is you take the profits, which is $20, and you divide it with sales, which is revenue, $100. So 20 divided by 100, therefore you get a profit margin of 20%. Okay? So in other words, if your revenue is $100 and if your profit margin is 20%, so therefore your earnings is $20. Now, in order for earnings to grow, you need the revenue of the company to go up, to increase over time. And you also want your profit margin of the company to at least maintain stable or increase. Okay? Unless you are telling me this, unless you say if let's say the company's profit margin is slightly declining, but the revenue of the company is growing faster than the slight marginal reduction in margin, then still the earnings of the company will grow. But here as investors, what we will do is that we will measure the growth rate of the earnings, and we want to also track the profit margin of the company. By understanding these two factors, then we can explain earnings growth. So what's the story behind AutoZone? Now let's take a look. So this is the case for AutoZone. Top half of the screen is revenue. Bottom half of the screen is net margin. So let's take a look at revenue. So for AutoZone, its revenue has increased from 9.1 billion US dollars to 18.9 billion US dollars in 2025. So from 9 billion to almost 19 billion, from here to here is a growth rate of 6.25%. Okay. Now, what about profit margin? So this is AutoZone's profit margin. It has increased slightly from 11.1%. It has increased all the way up to 14.95%. But in recent years, it has dropped a little bit to 13%. But if you are calculating over a 12 years period, where we are taking this as our starting point and this as our ending point, from here to here, this is a margin growth because this is higher than this, but the growth rate here is 1.44%. So which means for AutoZone, it has grown its earnings at the rate of 7.78% over the past 12 years. And in that 12 years, most of this comes from sales growth, 6.25%. This is the major contributor to earnings growth. But if you take a look at its margin, at least to say it has been relatively stable. All right, it has been relatively flat. Still important, a measure, simply because we want to know whether AutoZone has been controlling costs well enough or not. So in this case, it has maintained its profit margin. So I would say that for this company, the net margin has been relatively stable. Growth in revenue, stable margin, earnings growth. So this is equation number 4. And now we are going to move on to the final equation where we are going to invert further, lagi to understand what exactly is the contributing factor to AutoZone's revenue growth. So why is it that AutoZone can compound its revenue at a rate of 6.25% per annum, going up from 9.15 billion US dollars to 18.94 billion US dollars in 2025? So what exactly is the factor? Okay, so this will require the investors, which is like us, to understand the business model of the company. So for AutoZone, all right, it is a company that retails and distributes automotive parts. So the factors that drive revenue would be the number of stores that it has. And for each and every store that it has, what exactly is the average sales? Okay. More stores, more sales. That's factor number one. The second factor will be if per store sales go up, then revenue will also go up. So you need these two factors. And therefore, we are going to just assess for AutoZone's case, what is it like? What's its story like? So let's take a look. Top half, retail network. This is a measure. This is actually the reported figure of the number of stores that AutoZone has. The bottom half will be the average net sales per store. So in 2013, AutoZone has 5,201 stores. Each store is bringing in 1.74 million US dollars in sales. Okay, so this is the stats for 2014. In 2025, it has now grown its network to 7,657 stores. So from 5,000 stores, it has increased to 7,657 stores. Now, each store is able to bring in 2.52 million US dollars in sales. Okay, so what does that mean? It means that for AutoZone, its number of stores have increased. That's number one. And number two, the average sales per store has also increased. So take a look at the compound annual growth rate of its retail network and average net sales per store. We find that, hey, retail network has grown at a rate of 3.28%. As for here, the average sales growth rate is 3.16%. So these two factors, if we combine them, then you get a revenue growth of 6.25%, which happens to be in this equation over here. Now, so here, if we put the 5 equations, then we will understand the drivers to Attain Bagger. Now, let's take a look. Equation number 1, we established that total returns that you get or an investor gets from AutoZone if he invests in the stock in 2013 at a price of 420 US dollars. It increased all the way up to $4,200, 10 bagger stock. So in order for that to happen, the investment must compound your total returns or your capital growth must compound rate of. So how do you get 21.15%? You need earnings per share growth, EPS growth, 14.84%, plus a little bit of PE ratio growth. So for this case, 5.85%. How do you get EPS growth? You need earnings growth and you need share reduction through share buybacks. Now, how do you get earnings growth? You need revenue to grow and you need the company's profit margin to be stable. And how do you get revenue growth? You need its retail network to continue growing, and you need for every single store, its average sales to actually go up over time. So this is actually the factors that contribute to AutoZone hitting a 10 bagger. So at the end of the day, the story of a 10 bagger, right? How do you actually achieve it? It's not through trying to predict the market. It's not trying to time the market, predict the market, know about macroeconomics, all these kind of factors. Because at the end of the day, what drives a 10 bagger is actually business fundamentals. Because if you take a look at EPS, earnings, share reduction, revenue growth, profit margin growth, all these are related to the fundamentals of the business. So this is actually where investors should focus on if you are aiming to achieve a 10 bagger stock. Ah, so you just focus on this: revenue growth, earnings growth, cash flow growth. Cash flow growth is very important because with cash flow, you can invest in capex, and capex and business acquisitions will drive revenue growth and as well as earnings growth. So the first two here will go back into one and two. And then we have the third one, share buybacks, which will contribute to EPS growth because reduced number of shares will actually drive up earnings per share growth. And the fourth one will be, okay, you will get some dividends from a stock. All right. So therefore, the importance of cash flow. And last but not least, this is actually the most underrated thing in stock investing, which is whenever you buy a stock, just especially if you happen to buy a stock which is really good, just hold on to it for the long term. That's it. Don't do too much. After you buy it, just sit still and hold on. Just enjoy the ride. So these are the four things to focus on in order to position yourself to have a chance to achieving 10 baggers. Now the question is this: does it work for me? All right. Is this something that can work for me or not? Okay, let's explore. All right. So here, both Casey and myself, we have created Growth Walk, which is an online education program. And this education program, right, is specifically designed so that you can position yourself towards achieving your next 10 baggers. And even if it's not 10 baggers, then five, it can be how many baggers, Casey? Can we achieve 2, 3, 5, 10, 100 baggers?
Yeah, that's the ideal lah. I mean, you want to
That's the
double
idea lah.
your capital, right? A few years. So
Mm,
if you're doing like 7 years to double, then not bad lah. So 10% a year, right? But
mm,
if you can do it in a shorter time, 5 years to double, then congratulations to you. Okay. Uh, so that in your lifetime, in your investment time of 20, 30 years, 40 years, 50 years, you can double quite many times. So if you
mm,
double three times, already eight times. Two become four, four become eight, right?
mm,
You double another time, then you got your 16 baggers.
true.
Yeah.
But of course, there's a caveat lah. It's like we're not going to say 10 baggers in 1 year because
No, no, that's
businesses
not going to
really
happen.
that's not a good mindset also.
Yeah.
So we are looking at 10 baggers, and the thing is that to achieve the 10 baggers, right, most of the baggers actually happen at the tail end of the investment period, which means if let's say you have a 10-year horizon, right, the baggers will actually happen at the final few years one lah. Sure, we will have a little bit of we have returns over here at the initial stage, but the real bagger, the one that is like uh dominating your stock returns, right? The real big money is actually at the tail end. So therefore, there's a saying lah by the investment grades, temperament, the ability to be patient is very crucial to achieving these baggers.
Mm,
Not so much about skill, it's temperament.
yeah.
But let's see what we can do to actually educate our students to achieve the 10 bagger status. So let's take a look. We have two parts to this education online education course or membership. One is education. The second part will be case studies. So for education, we have three parts to it. So we have part one, mindset. We have part two, skill set. And we have part three, portfolio management. So in total, the education syllabus, we have 7 modules designed to helping students to achieve the 10 bagger status. So these 7 modules, the first 3 will be talking about mindset because we want to transform newbies, from someone who has little knowledge about stock investing, not too sure whether the mindset is right. So at least we get the mindset right,
Yes.
because many people, they come into the stock market as a speculator, all right, with that kind of mindset, wanting to make quick money. So here we want to transform the mindset from that into a business-like investor. So that's the first one. Then we move on to the next part, because at the end of the day, if you look at the five equations, there are a lot of accounting terms. All right. So basic accounting is needed. You don't need to be a CPA or ACCA, but at least you need to have a good understanding of accounting in order to find the best quality businesses in the world. All right. Because you're not going to get 10 baggers with mediocre companies. You buy lousy companies, you won't get 10 baggers. You only can achieve 10 baggers with fundamentally the most solid companies. Then you can get 10 baggers. So you need accounting skills, and you also need valuation skill, because you do not want to overpay for these stocks. So valuation is needed to prevent yourself from overpaying for the stock. And even better is, if you know valuation, then you can buy these wonderful companies at cheaper valuation, at the most attractive valuation price point.
Yep.
So you need that. And we will cover that in module 4 to 5. And module 6 and 7, because we are investing for the long term, as you can see, to achieve 10 baggers, you need to hold it up for 9 years, 10 years, 12 years, 20 years. It's a long period of time, and we want to help our students to survive the short term. Because if you can't survive the short term, every single news you also panic, then you cannot survive the long term, because short term already kill you. How to tahan for the long term?
Mm.
So, so here we are gonna have a syllabus to talk about how do we handle short-term price ups and downs, so that you can survive and even thrive for the long term. So that's the education. Now, the second part to our membership is our case studies, which is actually built for convenience. So what happened is that these are screenshots of what we are providing. So we have a summary. So we have the spreadsheet, which is actually sourced from the company's annual reports and quarterly reports. And we have the case study, which is also a summary of their annual reports and quarterly reports. So don't worry about a lot of figures, because the education part will give you the context to know, oh, what exactly is the story behind the numbers. And with that context, then you can invest with greater confidence, so that you know what you are doing, lah. Which means to say, if let's say you're considering a stock to invest in, you know the business model, you know the operating stats, you know the financial data, you know the growth initiative, and you know the historical valuation to it. So all these things, we will summarize it for you. And all you need to do is just have the context, do a little bit more calculation, and then, yep, it's plug and play. You can actually start building your portfolio. Now, the question is, what exactly is the price tag to this 10 baggers or 10 baggerdom? So here we have a special launch for Growth Walk. So we would like to announce it to you. The retail price of Growth Walk is 1788 per annum. And for KC Laos community, we are going to reduce the price for a limited time from 1788 per annum to 888 per annum. And this will be the final time of the launch where we're gonna, is it the final time that we're gonna
Yes,
launch
yes, it is.
this
It is.
price? 888. So this is like almost guaranteed that you're gonna get it at the lowest price lah.
Yeah.
There's no more lowest than this already lah. So this is the
The
final chance to get it
yes,
at
the next intake will
888.
be next year, and it won't be 888 anymore.
Mm.
Yeah, you'll
Yep.
never see these price tags anymore. Yeah.
Yep. So this is the final lah. All right. Final price already. And in addition to the discount, so for KC Loss community, we are also offering a three-part unrivaled guarantees. So we have guarantee one, two, and three. So let's take a look. So guarantee one, we have a 30-day money back guarantee. So which means to say it's important to see that, oh, let's say right now you are listening, you are a student, and we are the facilitators. So are we the right match? So if you find that after 30 days, find that we are not the right match for you, then you just email us at support@kclaw.com and KCLaw will process the refund, full refund to you for
Yes.
your triple eight lah. So risk-free for that's guarantee number one. Guarantee number two, lock for life 50% discount. So which means if you're getting it at 888 per annum, as long as you maintain your membership, it will be 888 per annum for life. No increments, no nothing. All right.
Yeah, we
The
don't do
increments will
things
come
like
for
Netflix
the
or
next batch
Apple.
of
Yeah. Yes, that means we,
mm,
we don't do things like when you do subscription for Netflix, for Apple Premium, or no, or other subscription you have, they will have increment due to inflation. But we seems like inflation doesn't happen to us. No, actually we absorb all the inflation. Okay, so
mm,
no, there'll be no price increase on your membership ever.
yep.
Mm.
Now we come to the final guarantee, which is very interesting, which is the growth investing challenge. So what happened is that essentially the points are this. The points of the challenges are this. Uh, First is that students are required to invest at their own accord, five stocks. All right. So we are given case studies. You can actually handpick, cherry pick which are the five stocks that you prefer to invest in. All right. So you do your own selection. So once you have the five stocks, counting from the fifth stock, so we have one, two, three, four, five. The final stock onwards, you have to hold on to the stock for at least 3 years. Now, after the 3 years period, if let's say the if let's say you invested 10,000, 10,000, 10,000, 10,000, 10,000, 50,000, and combined you have a capital loss. Let's say the total value after 3 years is not 50,000, it's $49,991. You have a capital loss of even $1, we will refund your membership fees uh, to you. So if you so in order for the 3 years to happen, it will be like 888, 888, 888, and let's assume plus one more 888 lah. So there are four 888s, then we will just refund that in total 3,000 plus dollars to you. Okay. So that is actually our guarantee number three. So just to recap the offer, then we can go into Q&A, which is this. So one is that if you are interested to position yourself towards a 10 bagger, you want to learn how to do it, then you can subscribe to Growth Walk. Is this the correct link, Casey?
Yes, that's right.
All right, so you can check us out. You'll be officially enrolled into the Growth Walk membership program. There will be a 50% discount, final chance. It will reduce from 1788 per annum to 888 per annum. There will be a 30-day money back guarantee. The 50% discount will be locked for life. And there's a full refund if you incur capital loss after invested in 5 US stocks and holding onto them for 3 years. So you can click onto the link and then you can check us out. So I'm not too sure when exactly is the final date to sign
14th
up.
of November is the final offer. Expire.
Oh,
Yeah.
okay. So this offer will expire on the 14th of November, 2025. And with that, thank you so much. You can contact me at ian@kclaw.com. And yeah, Casey, back to you for Q&A.
Yeah, nice. So let's do some Q&A. So we have some time. So since we are here, we will stay with you as long as you have question. So this is the best time to ask your question if you have any. And
Mm,
by the way, it's easier to just put the question in the Q&A box so that we can easily manage it. So let's get to the first one. For you say, okay, now you talk about the first formula where we have the capital growth actually come from the
mm,
earning per share growth, right? Plus the multiple expansion. So
Mm.
we mentioned about PE expansion. Then Foggy asking here, how about PB? Price per book value ratio.
Mm. How about PB? Yeah.
Yeah.
Uh, Good question. So this is actually where, uh, yeah, lor. Actually, you can do an experiment on that as well. Uh, but this formula is actually based on earnings lah. So essentially, this whole format, right, is actually designed, all right, for people who are into income investing. So which means we buy into a stock, not so much for its book value, okay, not so much for its asset, but it's more towards its ability to generate or to increase their income. So if you are looking to, so if you are looking to invest for income or growing income, and by growing the income, you get higher EPS, higher capital growth. So this is actually the route lah. All right. Now for PB, you of course as investors we can do the experiment. You can actually just you can actually just find companies, all right? You can just find companies that have been growing their shareholders' equity. That's why you get your B lah, B for book value. And then you see whether or not the stock price grow or not lah. But from our observation, from countless of studies, let's say we have a stock, okay? Or how about this lah? Let's make a guess lah, all right? Let's say we have a stock, and then for this stock, right? And you use a duration of 10 years. This stock is profitable. So this stock for the past 10 years has been very profitable, but its profit declined. All right. So which means last time it used to make 1 billion, then 900 million, 800 million, 700 million, 600 million. So the earnings have been declining. But this stock never paid dividend. So all the earnings is retained within the company. And because of that, the stock's equity actually go up. All right. So your earnings go down, but the stock's balance sheet, the shareholders' equity, because you retain all the earnings, the
Mm.
shareholders' equity go up. Now, in this situation, will the stock price go up or come down?
The
Type in the chat box.
price. Hmm. So the company is making less and less money, but it's still making money. But the book value
Yes.
increase, right? So what do
Yes.
you think will happen to the price itself? Just the price.
Mm.
Do you think the price will go up or go down? No, type in the chat box.
Ah.
Good question. Yeah, something to ponder.
Mm. You let me know.
What do you think, Foggy?
Ah. Equity go up, earnings come down
Yeah,
for the long term.
yeah.
What do you think will happen to the stock price?
How about others? You can type in the chat box.
Yeah, just type in the chat box. Let us know
What do you
what do
think, right?
uh
Yes, yes. So I think it's quite an easy guess, right?
uh
Uh, we we are not certain that it will go down.
mhm,
We are not certain that it will go down because it's still making money, but it's just making less and less, right?
mm,
Mm. So most certainly it will go down, right? Most certainly lah. I will say most probably lah, it will go down because it's making less and less ma. So it means it's worth less and less, isn't it?
mm,
You buy a Starbucks store and then the store is shrinking. That means the sales every year it make less and less and less, but still haven't gone into loss yet. But it's making less
mm,
and less, so it should be less valuable lah, that store, isn't it? Then the
mm,
price logically should go down, lor, right?
mm,
Hmm. Then if price go down and then your equity goes up, that means your book value goes up. Then your PB multiple will shrink.
mm,
Maybe it start with PB of 2, then it will shrink, become 1.5, become 1.3, become eventually less than 1,
mm,
right? So I guess that's the logic behind that. Lor. So I think I want to add on is, Ian, maybe you show us the formula number 1. So I guess Foggy's question can be this as well. So the formula number one,
Mm-hmm. Which
equation
one?
number one, yeah. So number two, maybe equation number two with the expect is with the PE, PE
Mm,
expansion. Yeah. So the PE growth. Now we put PE growth. So in fact, the real answer is actually not PE growth. The real answer should be multiple growth. So that multiple means relative to the price and the things you get.
mm,
That's the multiple. So it can be PB, it can be PE,
mm,
it can be PS, price per sale.
mm,
It could be, right? Because some company, like for example, Amazon at the early stage, the sales keep growing, but their profit never like show high growth because they put a lot of money to just to reinvest back the company, right?
mm,
They're expanding their logistic, they build out a lot of warehouses.
mm,
So those kind of thing, maybe you don't see it in PE growth because the PE
mm,
is always high because the earnings is low. Then the PE always like, oh, 40, 50 like that. So you look at it, wow, very crazy.
mm,
And then it can be PB as well. And PB growth can be applied for company which is a conglomerate. They own a lot of business, for example, like Berkshire. Then
mm,
PB is a better ratio to look at, right? So this formula is not like fixed. You have to be PE. We just put simply PE so that you can understand the situation because most of the company operate this way.
mm,
I would say like 80%, 90% of the company out there actually just you look at the earnings, right?
mm. Yeah.
Yep. So I guess we hope we answer your question, Foggy.
Mm-hmm. Exactly.
Okay, so
Yeah.
maybe we get to the next question. This is by KK. Is it 10
Mm,
baggers need to be at least 10 years duration or less time can achieve?
mm.
Ah,
So with that, let's look at a compound annual growth rate calculator. So, all right. So now let's say you have investment value of 10,000. Hamburger will be like 100,000. So 10 years is too long, right? So if you want it done in 10 years, somehow rather the stock price
had to
has
grow
to compound at a rate of
26
25.89%,
ah, 26%
26%.
a year for 10 years
Mm.
consecutive just to get 10 baggers in 10 years.
So if you
Hmm,
want it half the time, then somehow rather you need the stock price to actually go up at the rate of 58%
yeah,
annum.
yeah,
So the question is, once we understand this, all right. So if here if you need to achieve 58% here, so the question is, what sort of driver over here that is gonna support 58%?
yes,
Ah, so that will be the question.
yes,
Mm. So is it earnings per share growth? Is it this? All right. So if let's say here need to grow at 50% per annum, wow, then what exactly will be the earnings growth rate over here? Is it
yeah,
30%, 40%?
yeah,
So you somehow need to handpick a stock that could actually grow its earnings by 40% consistently for 5 years lah. All right, since you're talking about 10 baggers in 5 years, half the time. You need to somehow find a stock that can grow its earnings at the rate of 50% per annum
mm.
for 5 years to actually achieve a 10 bagger. So Casey, what is the difficult is this what's the level of difficulty for doing that? Simple, easy?
I would make a metaphor here. So
Mhm.
it's like it's like you are betting on something because the probability is so slim to get a
Mm,
company that can actually grow at this rate and for 5 years straight. But there are, of
mm,
course, there are stocks like that.
mhm,
Mhm. But it's very difficult to find them.
mm,
And then sometimes you find them, you really don't know, is it because we are buying for the future, ma? So
mm,
you buy now and you are waiting for the next 5 years. So
mm,
the thing is how sure you are the next 5 years they can increase their earning 60% a year.
mm,
Mm. For example, so you have to imagine yourself. You are a company yourself. You are a person as
mhm,
an individual. You earn money, right? So imagine
mhm,
yourself, you earn money. So this is like 100% within your control because
mm,
you do the work, right? You spend your time. And then can you confidently increase your income 60% a year? That means this year you make 100,000, next year you make 160,000. Another year you have to make 60% more. So it's close to 250,000, right? And then
mm,
you make another 60% more. So even for your own, I'm not confident to say that, right? I'm not confident to say, okay, it's totally within my own control.
mm,
I also not confident that myself can make so much money every year increment, right?
mm,
So now you're investing in other business. So that's the probability we're looking at. No? Not to say that it's impossible, but it is very close to the impossible side, lah, extreme. Lah.
mm,
So what we have in growth is that we look at the history of those very good businesses already proven. They have done it for more than 10 years. Then we try to look at their past performance and see if they can still continue doing that.
mhm,
Mm. Then you have a more you have a higher chance, probability to get that 10 baggers. So you can see all the companies that Ian put up on one slide, where 10
mhm,
baggers takes usually more than 10 years, right? There's a slide,
mhm,
I think in the beginning, you want to show that back. So you see the best company, biggest of all, not Nvidia. Nvidia is not here. Nvidia, I think, could be the shortest already. The other
Yeah,
one,
NVIDIA is the
Apple,
shortest.
9 years, Alphabet, 10 years,
Mhm,
Berkshire, 22 years. You see, Microsoft also 9 years. So
mhm.
Nvidia, how many years?
NVIDIA should be
Two,
five
three
lah.
years.
You can actually see but
Yeah, we can look
of
at the stock chart,
course,
then we kind of like know.
so you can just put to max, and
Yeah.
then
I think within 5 years, you can see 5 years.
so if this is 200, then you need to buy it at 20 lor, right? So
Mm-hmm.
when's the first time it appear at 20? Then
20.
so
It's 3 years. 2 years.
ah
2 year and
this
a
one
half. 2 year and a half.
ah yeah lor. So
Mm.
that's the case lor.
Yes.
But as a cost, as a designer or facilitator of the course, so the question is because we are also looking at how easy is it easy, is it something within reach for our students to actually replicate certain kind of result mah. We can't be building a course based on a one time hit wonder or something like that, right? So we so so it's actually so we are also considering that in our in the curriculum lah,
Yeah.
like how possible it is for our students to come in and learn up the skills
Yeah.
and then hit their baggers. So that is actually also
So
something that
this
consider.
is Nvidia for the past 3 years, right? So if you
Yeah.
look at the first time when they were $2,
Mhm. So 50 cent.
mm,
So these are 400
$2.
people.
Ah, so it's like the first 10 baggers it happened when, if you are holding on to Nvidia, you can buy before the $20. So you buy at $2.
Mhm.
So the first time 10 baggers, right? So now two time 10 baggers is about 100 baggers, isn't it?
Mm.
So $2 when? It was 2016, 20. 2016 over there, yeah, around
Yeah.
2016, 2016
Mm,
to 2023.
mm,
Mm.
yep.
Also quite fast, 7, 8 years,
Mm,
less than 10 years.
mm, yeah. But of course, lately I learned something lah. Like, let's say we talk about the coffee can portfolio
Mm.
whereby uh, it's actually a chapter lah in the book. Because the whole idea of this presentation like this is a 10 bagger thing but there's a book, all right, by Chris Meyer, all right. He wrote about the 100 bagger So Nvidia has already achieved 100 bagger status not 10,
Yes.
it's 100
Mm.
bagger.
In the
But
shortest
why
time.
but here is like why do we actually drop it to 10? It's simply because in the US, they are already 10, 20, 50, 100 baggers, and it's actually a norm in the US. But in Malaysia, it's not a norm. It's not like it's not exactly a norm because if you just happen to invest only in within Bursa Malaysia, right? There's no stock, all right, that has actually hit 100 baggers, or at least I do not know. Simply because the only stock where the stock price is actually above 100 ringgit is Nestle. That was only once upon a time, right? So,
Mm.
so how do you, so how, which stock can actually give 100 baggers? It's not known, all right? At best, we find, yeah, there are some stocks that hit 10 baggers, 10 bagger status in Bursa Malaysia, lah. But to hit 100, maybe that is actually, perhaps this is also why the total addressable market of a country matters in achieving this kind of baggerdom status. You need a market to support it. Ah,
Okay.
yeah. So so what I'm saying is that sure it's nice to have 100 baggers, but we try to hit it 10. But of course, even if Nvidia is like that, but usually in investing, we'll build a, how I say, when we build a portfolio, it's not a one stock portfolio. We'll have multiple stocks. So even if you allocate, let's say 10 here, 10 there, 10, 10, 10, 10, 10, 10,000 into each stocks, right? At the end of the 10 years, you see some stocks will be like, okay, you will hit jumbo status. All right. Some will be doing fine. And then there are others that may not be, that maybe it's a mistake. It didn't turn out right. But it's okay because the jumbo status actually can offset the non-performing stocks that you have picked uh, initially because of a mistake or something like that. So the good still outweighs the bad. Yeah.
Okay.
Any more
Good
questions?
clarification. Any other question? If not, then we're going to end the session.
Mm,
Uh, Connie putting up a comment. He said, I'm glad today's learning. I catch the point. Multiple growth.
mm,
One, number of stores times sales volume. Number
mhm,
two, earnings. Number three, margin. Number four, PE, each increasing slightly and consistently, plus share reduction each year. Yes,
mhm.
that will actually contribute to the overall growth of a company. Yep, you're
Yep.
right. Thank you, Connie, for the summary. And if there's no other question, then we're going to end the session. And we actually have the same content, but we will do it in Mandarin, in Chinese, later
Mhm.
today on 2 o'clock. So if you want to come back and have more questions, and suddenly you've thought of something, then you can actually come back and we can have a great discussion then.
Yeah, so I'll just as a
Mm,
add on to the summary, right?
mm,
So it doesn't matter what stock uh Bursa Malaysia, Singapore, Hong Kong, US So the five equations is actually my way of doing post-mortem lah. So if you just give us any stock, then I'll be like, okay, this is a stock. And then if you want me to explain like, hey, why this stock, it doesn't seem to go anywhere. Then I will start using this as a mental tool to actually start to identify clues lah. Why this stock is not going anywhere. And if you happen to find a stock that is going somewhere, a 10 bagger stock, then I will still use the
Mm,
same model to actually explain why these things
mm,
happen lah. Ah, so this five equation is a very powerful equation lah. So you may
yeah.
want to actually jot it down and practice it lah, master it lah. You'll do very well
Yep.
with these five equations.
Once you understand this, this is actually the back end, the mathematics side, right? So this is like everything will give you these numbers if the business doing the right thing.
Mm,
But business is very dynamic, as I always say. We are buying it for the future. So mainly, I think the most important thing is that when we buy a company, how confident we are, they can still
mm,
do the same thing by increasing their revenue, increasing their earnings, maintain their margin, right? The margin will not be reduced. Is there any competitor is going to take a share from them and result their margin to decrease? Will that happen? Right? So these are the things you have to answer. You have to know for sure. Then you will be confident to hold on to a stocks for a long term.
mm,
Yeah. So that's the we so called the qualitative side lah, the quality side of the business. So these are the
mm,
number side. Number side, if the quality side is good, then it will show all in the quantity side, right? Or the numbers will show.
true. All
Okay,
right.
awesome.
So yeah, do check us out. Go for.
Yep.
There's a link somewhere. So click onto it, have a look, consider it, and if it works for you, uh welcome to the membership. See you online.
Okay, bye bye. Thank
Bye
you,
bye.
everybody.